Thank you, Dave. Pretty cool that I'm on a roster here with Jake Bernstein. He did a lecture with Larry Williams, and that turned my trading around completely. The subject was mechanical trading. So hopefully I'll be able to inspire someone to the same degree that I was. Going to look at 3 mechanical day systems that are easy personified. You get in at 8:45, but I'm getting ahead of myself here. Briefly, I've been a member of the Chicago Board of Trade for over 35 years. I'm the author of 4 books on trading the financial futures markets. I've also done yearly wrap-up almanacs, 4 of them, done lectures, articles. And off of me. Mechanical trading. We all know what that is, I assume. It's trading by hard and fast rules that are completely cut and dried, not open to any kind of interpretation. They're derived out of back testing. So again, I was trading willy-nilly like most people start out and losing all the time. Attended the lecture with Jake Bernstein, Larry Williams, turned it around, became 100% convinced in mechanical trading. So why should you maybe consider it? Well, because 90 to 95% of traders lose money to the remaining minority. Since most people are neither systematic nor mechanical and they trade according to whatever whim strikes their fancy at the moment, it stands to reason that instant psychological gratification will land you in a typical trader in the loser pool. Most people are resistant to taking losses. We have in the back of our minds there have been trades that were hairy and scary, and we got stubborn, hung on to them, and were rewarded when they recovered. Well, it's not something you want in the back of your mind. That is bad reinforcement. Okay. Also, bad reinforcement. We remember trades that were on paper profits that got away from us and became losses. And most people attempt to impose order where there is none. Markets are like 99% noise. There's a small trending component that systems latch onto. People often lose sight of the only reason to trade, which is to make money. Trades people fear the most tend to pay off the most. I have all kinds of anecdotes, personal anecdotes, where that is the case. I've come in terrified because the number comes out one way and I'm positioned the opposite way, and by the end of the day, I'm rewarded. Biggest problems arise in trades in which people are the most comfortable, complacent, and confident. Flip side of the previous. That is also true. If you're feeling that a trade can't miss, you might want to be extra cautious. Mechanical trading bypasses emotion and natural psychological wiring. Takes the worst element of all, the human element, okay? It imposes accountability and discipline in following trading rules and working toward goals. All right, creating your own systems. I'm going to give you a series of rules here. First, know that your data and tools are reliable. I use TradeStation data. It's not perfect. I've found many mistakes in it. At this point, I would not trust AI data if there were, in fact, any. Choose a market that has both good liquidity and volatility, particularly if you plan a day trade. Liquidity means that you will be able to get in and out of the market without giving up fills. you'll be close to where your theoretical entry and exit were. Let's go back to that a second. That's liquidity. Volatility is the market has to move an X amount of distance for you to be able to get a trading arc and profit off it. Make sure that your testing field is large enough and that it incorporates a wide array of market environments. Okay, you have to have a statistically significant amount of trades, and when you're looking at a data field, it has to incorporate pretty much all the market environments, right? Bull markets, bear markets, sideways markets. That's usually automatically solved if you're using at least 5 years worth of data, but check it anyway. Know where the theoretical world diverges from real world trading. I'll give you a couple examples of where that's not the case. Doing something on a close. Your system says exit on close, or it says exit on close if the price is below this or above that. Well, the official closing price isn't established until a millisecond after the last tick, so they're not going to fill you on an automated system. Another example is when you're trying to buy and sell limit orders, your performance summaries are going to show you filled on every order that is penetrated. You'll get every one of those, at least in Chicago markets. But they'll also show you as filled on orders that are where your price is touched but not penetrated. Okay, they'll say that you were filled on every one of those. You will not be filled on most of those. So you have to know, again, you're creating a model. The idea is of which you're going to be able to trade exactly as it is in your theoretical world into the present and the future. Understand your drivers and test only in support of theories or concepts you believe to be true about the markets. I give 4 rules of optimizing your systems prudently. Rule number 4 is the idea that you have to have some idea, some common sense of what you're testing and why. And the main reason for that is the first 3 rules do not always catch a faulty system. All right, this is important. Hold off some of your data when you're testing. Okay, the standard procedure is to leave out your last year. The idea of that is when you're optimizing and numbers crunching, comparing and contrasting variables and whatnot, you want to have a time period where that is not part of that process. Because when you come up with something and then you apply it to that so-called version field, that is acting as more or less a virtual future. You don't want to see it blow up in an area that was not part of the jerry-rigging of your numbers. Initial testing should be wide to find a frequent bias. By wide, I mean don't put all your fine points in there right away. Don't put your stops. Don't put more qualifiers than you absolutely need for the concept. The refining will come later, or when you narrow in with additional rules, stops, and filters. Make sure you have enough trades for statistical significance. I got ahead of myself a little bit there. I mentioned that before. You have to have enough trades for it to have any meaning. Rule of thumb is I look for hundreds at least. Design your systems with variables that can be optimized. Okay, use N instead of a hard number because N will be used in the optimization process where you'll get a whole array of results for N from You know, you set the start 3 and the end 10 or whatever, and you'll be able to see all the different results, one atop the other. But don't over optimize. Study your optimization results for best outcomes. Okay, this is one of the 4 rules of prudent optimization I alluded to. The number that you settle on should reside in a neighborhood of similarly good results. It should not be a standalone diamond in the rough. If you have to go to your second best or even your 4th or 5th best in order to get a reasonably robust result, go to that. Don't settle on something that's isolated. Add slippage and commission to the strategy you selected. Good rule of thumb in a liquid market is cost of commission plus 1 tick. Test the system with the data you withheld from the past year, that virgin data we mentioned. That's crucial. You want to see it hold up in that field reasonably well. Again, it's significant. That was not part of your jerry-rigging process. The return on account is the best measure of a system. You have an option on what you test for, what you optimize for. It could be best net profit, best percentage profit, best average trade, et cetera, et cetera. I almost inevitably test for best return on account. And that's your net profit divided by your worst drawdown. That gives you a percentage that you would have enjoyed in the data field had you started with your worst drawdown amount. So that gives you your results in relative terms, not just what your final reward was, but also how much heat you had to take in getting there. Examine your trade list and periodic returns to make sure your gains are dispersed more or less evenly throughout the data field. This is another one of the prudent optimization rules, okay? If your results, if 80% of them come from a market crash and a subsequent recovery that lasted all of a week, you don't have much, okay? Of course, you're going to have losing periods in your data field, and you're going to have mishmashy, nondescript, put and take, but for the most part, you want reasonable distribution of profit, okay? Overall reasonable distribution. Look for similarly positive results in other markets, particularly closely related ones. I would not trade a barn burning system result in the S&P if it was a negative system in the Dow, for example. Doesn't mean that the other markets have to be good enough to overcome your trading costs or whatever. It just means that the bias has to be there. Okay, you need affirmation. An ideal goal for trading multiple systems should be low correlation between them. If you're trading similar systems, what you're actually doing is you're adding to your position, long or short. You're adding contracts. If you want diversification, you have to make sure that there's low correlation. All right, this may be a no-brainer, but you would be amazed at how many silly little things can just mess up your day completely. Have a plan for computer going down, the internet going down, technical problems. Have your trading desk phone number in your speed dial, for example. Keep your coffee away from the computer, things like that. And finally, go back and double check everything. Now, I think the best market to trade, and it has been for years and years, is the mini S&Ps. Because again, they have that combination of volatility and liquidity, which is important, especially in day trading. The S&P futures track the underlying S&P 500 index. They are 1/5 the size of the now delisted standard size S&P 500 futures contract. There's no physical delivery. It's all settled in cash. It's one of the highest volume futures contracts. Again, that provides the liquidity we're looking for. A minimum tick is 1/4 of a full point. A full point is worth $50 per contract. A tick is worth $12.50. Now, I should also mention, I don't have it on here, but there is a micro contract that has a value 1/10 the size of the mini. In other words, $5 for a full point, $1.25 for a tick. Contracts expire in March, June, September, and December. We just had a recent rollover into June. Choose S&P futures because high volume means better fills. Volatility means increased opportunity. High volume and volatility are good for day trading. Probably should have said are necessary for day trading. All right. So you don't want to be a seat of the pants trader because we are not wired to trade well. It's just human nature. So we're going to sit down and create a system. What do you need to do? A historic data field will let you back test trades from a devised strategy code. If the result is a suitably robust aggregate profit, the plan is to actually trade it exactly as it was applied to the data field. And imagine underlined exactly and put it in boldface. 99% mechanical is not mechanical. I'm afraid that most of you are going to find that out the hard way. It's just human nature again. You will likely have several choices in sizing your system rules. One of them will be optimization, which determines the best variables for your system. Now, if someone were to ask me, what is my best indicator for day trades? Okay, I would say it is the 8:30 a.m. Central Time day session open. It can act as a great demarcation line. You want to tend to be bullish above it and bearish below it, all other things being equal. Be inclined to be long when it's above the open and inclined to be short when you're below it. I venture to say, regardless of whatever system you're talking about, it probably would be improved if you did not take longs under that price or shorts above it. Second thing I would say is that the earlier you can establish a position, the more successful you're likely to be. All right, the ultimate first 5-minute move is the key. I should say the ultimate validation of this concept is something that I've been using in one form or another for years. Set your chart to 5 minutes, day session, 8:30 a.m. to 3:15 p.m. Central. We're not talking the 4 o'clock close. We're still on the 3:15 so-called classic close. At the close of the first bar, 8:30 a.m. Central, 8:35 a.m. Central, buy if you're above the day session opening price. First 5 minutes of trade is up, in other words. At the close of the first bar, sell short if you're below that opening price and exit at the 3:15 p.m. day session close. Couldn't be simpler. Here you clearly see that the first bar was lower from the open to the close. Well, maybe it's not that easy. The ticks are kind of mushed in there. Take my word for it. That was lower. Here you really can't see it, but it was a slight up move from the open to the close. That's a long. And again, this is the same idea that I've been posting for probably going on decades now. This is not, as is, a standalone system. This is your big bugaboo here. You would not want to take, a $41,000 drawdown at your worst level. But biases are valuable, even if they're not good enough to make actual systems out of them. Because take this bias, you can incorporate it as one of the blocks in a more complex system. I do it all the time. So here you can see that the concept holds up in the 5 major stock-related U.S. index futures. You can see that we're not exactly talking flukes, given the sheer number of trades. This was, by the way, from the start of 2015 through the end of 2023. If you go forward, you'll see similar results. If you go back years before 2015, guaranteed, I've already seen it, you'll see the same thing. It's just a great bias. Okay, that may be at or near the very best of the biases, time targeted wise. But I'm going to show you that it doesn't matter that much as far as where you're going to find winners. This is an optimization study of every 15 minutes between the 8:30 open and 2:30. Okay, this represents the first 15-minute bar between 8:30 and 8:45, between 8:45 and 9, between 9 and 9:15, et cetera, et cetera, et cetera, down to 2:30. And it says that, again, if you're above the open at this time, be a buyer right at the market. If you're below it, be a short seller. Hold the trade until 3:15 p.m. So you see one bar here. I believe that would be 9:30 maybe, 9:15, 9:30. It really doesn't matter. The fact that it's a loser here, I would not give a special significance to that time bracket. This is how it panned out in the 2015 to 2023 time frame. All right. Next, we'll go to the Dow. Dow isn't working so well now. Used to work a little better. My theory is it'll come back again. But the Dow is kind of a strange animal. Of the 5 indices, it is more of a laggard than a go with, at least relative to the other indices. I've got another strategy that I frequently use. I look at the S&P compared to the Dow, and whatever move you're talking about, up or down, if the S&P is moving in that direction on a greater percentage basis than the Dow is, that gives validity to the move. You don't want to see the Dow leading. So that might explain in part why the Dow is a little funky on this concept. But here, let's renew our faith here in the NASDAQ. Here you see not one losing bracket. And such is the case in the Russell. Not so much in the mid cap, but still a definite bias there. By the way, don't trade the mid cap. It's the one market out of the 5 that is not liquid at all. Okay. Is there another reason to trust early entries? I'm going to give you something here that is going to completely demolish the whole random walk theory. Okay. What would you expect How often would you expect a market to open within what is going to prove to be, by the end of the day, the bottom 5% of the day's range? How often would you expect it to open within the top 5%? The two together, 10% of the time, right? 5% each one, 10% of the time. The actual results are closer to 15. Where'd you go? Are closer to 15%. Okay. How often would you expect top or bottom 10% of the day's range? 20% of the time is what you'd expect. It's over 25. How often the top or bottom 15%? You'd expect 30%. It's getting close to 40%. So that's not just random movement, okay? And it kind of shows you want to get into whatever trade you're going to use as early as possible. Since 2015, the S&Ps have closed at least 1% higher or lower on roughly 1 out of 5 days. Okay. So I'll ask the question, when when the market is in progress and you hit 1% higher or lower, would you expect the move to continue, or would you expect it to reverse and get closer to the mean? The answer is you are statistically better off expecting continued momentum. So years ago, I came up with this idea: on any 5-minute bar close between 9 a.m. and 2:30 p.m., if the net change on the day is 1% higher than the previous close, buy at the market. If it's 1% lower, sell short at the market and exit on the close. So previous close. At this point, you're within the permissible time frame manner, and it hits the 1% down, you sell short. Just the opposite here. This is previous close. Here within a lot of time frame, you hit 1% up. You're a buyer. Again, this was devised years ago, and I guess the Russell and the mid cap especially have stopped cooperating. I suspect it'll come back. All right. Trading in the first 15 minutes. I'm going to give you 3 variations on this concept of getting in the market at exactly 8:45. Set your chart to 15-minute bars. Day session 8:30 to 3:15 p.m. Central Time. At 8:45, if the open is within 7 ticks of the low and more than 7 ticks from the high, go long. If the open is within 7 ticks of the high and more than 7 ticks from the low, go short. Exit at the 3:15 p.m. Central close. Session closed. All right, this is the concept of start wide. We don't have a lot of qualifiers yet. Speaks for itself here. And you see corroboration almost across the board. The Dow is pretty much a break even. Nice return on account in the S&Ps. Drawdown is not quite manageable, but getting there. See if we can make this a little better. This time, let's go to 10 ticks. It's got to be within 10 ticks of the low and more than 10 ticks from the high to go long. Within 10 ticks of the high and more than 10 ticks of the low to go short. This time, we will add a $500 profit target and a $500 stop loss. And if neither side is filled, again, out at the 3:15 p.m. close. So I just included another visual to show you the difference of maybe getting out early. Here it was in the first 15-minute bar. You see that we turned the Dow from a break even to a winner. S&P return on account a little less, but you got a decidedly manageable $9,000 drawdown now. And you got a comparable system, slightly better return on account. And again, corroboration across the board. And let's do one final variation. We'll stick with the 10-tick rule. It's within 10 ticks of the low and more than 10 ticks from the high at 8:45 to go long. At 8:45, if you're within 10 ticks of the high and more than 10 ticks from the low, go short. This time we'll take the profit target off. We'll leave the $500 stop loss. But this time we're going to get out at 11:45 a.m. I like to vary this in my own trading. And I like to think of people that want to hit the golf course before noon. This is for you. Again, got a very nice, probably the best of all return on account. The S&Ps. Drawdown stays around $9. Now we got a definite boost in the NASDAQ. Russell still looking pretty good. Probably the most consistent of the three. All right, so your takeaways are day trading advantages include no overnight risk, a clean slate every day, less stress, and an ability to leverage more from less trading capital. That's because they make your margin requirement much more generous, maybe 4 or more times what it is to hold a trade overnight. Day trading is especially suited to the E-mini S&P in that it has both liquidity and volatility. The day session opening price is an effective tool for determining long or short bias. And finally, I gave you 3 systems for early morning momentum that trigger in the first 15 minutes of the day session. And that's it, folks. Appreciate you joining me.